Hi friends, welcome to my channel InfoCraze. In today's video, we are going to check some basic accounting terms which are very important for students and beginners in the field of finance and accounts. As you will come across these terms quite often in your accounting journey, it's crucial that you have a clear understanding of these basic terms. Before we proceed, request you to subscribe to my channel for many more informative content like this. Now let's get into the world of accounting together. Let's start with a very important term which is very commonly heard in the corporate world. What is net worth? Net worth is the value of all the assets a person, company or an organization owns minus the liabilities they owe. Thus, net worth is equal to total assets which include current assets like cash, inventory, accounts receivable and fixed assets like property, equipments, etc. minus total liabilities which include current liabilities like accounts payable, short-term debt, etc. and long-term liabilities like bonds payable and long-term loans. In other words, it is equal to what we own minus what we owe. In the event of a business closure, this amount is available for the owners after payment of all liabilities. Thus, net worth is also called the owner's equity. A positive net worth means that assets exceed liabilities, while a negative net worth means that liabilities exceed assets. Net worth is an useful indicator of the financial health and stability of a business. The next term we discuss here is debtor. For a company, a debtor is an individual, business or entity from whom money is due against sale of goods and services or any other contractual obligation. In other words, a debtor is a customer or client who has made a purchase on credit but not made payment to the company yet. Debtor refers to not only the customers buying goods and services in credit but also to someone who borrowed money. Total amount due from all the customers of a company is called accounts receivable or sundry debtors. Let's take an example. A company named ABC Electronics sells electronic goods worth of $10,000 to its customer named XYZ Retailers on credit with a payment term of net 30 days. Thus, ABC Electronics is the supplier and XYZ Retailers is the customer. In the books of supplier ABC Electronics, XYZ Retailers is a debtor till $10,000 is paid back by XYZ Retailers against their credit purchase. This amount will remain as accounts receivable or sundry debtor in the books of ABC Electronics. Now, debtors may be classified as good debts. These are the debts which are sure to be realized. Doubtful debts. These debts may or may not be realized. And lastly, we have bad debts. These debts cannot be realized. Next term we have here is creditor. For a company, a creditor is an individual, business or entity to whom money is due against purchase of goods and services or any other contractual obligation. Thus, a creditor may be a supplier who has sold goods or services on credit to the company against which payment is yet to be released. In our earlier example, the supplier ABC Electronics is a creditor in the books of XYZ Retailers. Amount payable to the suppliers and other entities is called accounts payable or sundry creditors. Next one is double entry system. Double entry accounting system, also known as the double entry bookkeeping, is a method of recording financial transactions where every transaction affects at least two accounts. In our earlier example, XYZ Retailers bought $10,000 of goods from ABC Electronics on credit. In the books of XYZ Retailers, the transaction would be recorded as follows. Debit inventory account $10,000, credit accounts payable account, that is ABC Electronics account $10,000. Thus, every transaction involves a debit and a credit. The total debits must equal the total credits for all the transactions recorded in an accounting period. This system ensures that the accounting equation always remains balanced. That is, assets equal to liabilities plus equity. Next term is also very important. It is COGS. COGS or cost of goods sold represent the direct costs involved in the production of the goods sold by a company. It includes the cost of materials and labor directly used to manufacture the goods. It excludes the indirect expenses such as sales and distribution costs. Components of COGS include direct materials. These are the raw materials used in the production of goods. Direct labor, wages and salaries of workers or employees who are directly involved in the production process. Manufacturing overhead, costs directly linked to the production process such as electricity cost for operating factory machineries, factory supplies, etc. Basic formula for calculating COGS is beginning inventory value plus purchases during the year less ending inventory value. COGS is a crucial figure for determining the gross profit and overall performance of a company. After COGS, the next term which comes here is gross profit. Gross profit is the difference between a company's total revenue and the cost of goods sold. It represents the profit earned by a company from its core business operations before deducting operating expenses, interest, taxes, and other non-operating expenses. It is an important indicator of a company's financial health. Basic formula for gross profit is gross profit equal to revenue minus COGS. Gross profit is reported on the income statement directly below revenue and COGS. Gross profit when expressed as a percentage of revenue is called the gross profit margin. That is, gross profit margin equal to gross profit divided by revenue multiplied by 100. Hope you have understood all these terms. For more accounting terms, you may refer to my earlier part 1 video which is provided in the end screen. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Please subscribe to my channel for many more interesting videos in the field of finance, accounts and costing. If you have any question, please leave your query in the comment section. Thanks for watching.